Look left, and you see a market acting invincible. Look right, and you see a mathematical anomaly. 9-day fear is on clearance. 30-day uncertainty is not. The S&P 500 is lying to you. Not maliciously, structurally. Price tells you the future is bright and smooth. Volatility tells you what protection actually costs. Right now, at the time of recording, the VIX 90 is reflecting a massive discount to the VIX. We're sitting around the 99.6 percentile for that discount, meaning only 0.4% of the time in history has near-term protection been this cheap versus 30-day protection. In a second, I'll show you 4 receipts, 4 modern stress tests, where this structure dial dipped below a line and drawdown risk followed. Then we come back to what it's whispering right now. Because if you're watching the market through headlines, you're watching shadows. If you're watching it through volatility structure, you're watching the plumbing. And here's the uncomfortable truth. The plumbing changes before the living room looks messy. That's why serious risk managers care about the insurance market. Not because they're afraid, because they're practical. Most people treat volatility like one number, the VIX. But volatility is a curve, not a dot. 9 days is next week. 30 days is next month. 3 months is next quarter. 6 months is next half. A year is the long shadow. That curve is the market's insurance bill, priced across time. When it steepens or compresses, fear is being repriced in real dollars. So the question isn't bullish or bearish. The question is, what kind of risk is being priced and when? Think about it like this. If you're buying insurance for your house, you don't ask, is insurance high or low? You ask, is insurance high for tomorrow's storm or for the whole season? The VIX is the season. The VIX 9D is the storm. Right now, at the time of recording, the season looks expensive, but the storm is on clearance. Here's where we sit. The ratio is hovering around 0.70. Historically, almost all the time, it's higher than this. What does that mean in plain English? It means the market is paying relatively little for immediate protection and relatively more for protection further out. It's the market saying, I don't expect trouble in the next few days, while also saying, I'm not totally comfortable about the next month. This often happens when near-term options aren't being bid. No obvious catalyst, no immediate fear. There's no scheduled explosion, no meeting circled in red ink, no single headline everybody is bracing for. But it doesn't guarantee calm. It just describes pricing. And pricing can change faster than opinions. If something hits while protection is this cheap, repricing can get violent. Not because the world ended, because the world moved, and the insurance market was underpriced for the move. That's why we don't worship the ratio. We rank the entire structure. When we rank the whole curve, we get one percentage, the Styx Curve Rank. It's the single number that synthesizes the entire curve. It's one map. And that map has a line in the sand, 30%. Above it, the structure tends to be supportive. Below it, the market's posture tends to change. Let me be very clear about what posture means. It does not mean destiny. It does not mean crash confirmed. It means the distribution of outcomes gets uglier. It means the odds of air pockets tend to rise. It means the market is less forgiving. And yes, that matters most when the price looks calm. Because calm is the most seductive kind of risk. It makes you size up. It makes you loosen rules. It makes you believe the absence of pain is the presence of safety. Now, let's look at the evidence. I want to show you exactly what this line looked like 4 times before. 4 times the Styx rank slipped under 30%, and the market stopped being cute. Receipt 1, August 19th, 2015, the China flash crash era. Markets looked normal until they didn't. Here's what people forget about 2015. The fear didn't arrive with a marching band. It arrived like a floor giving way. One moment, you're watching a normal market. The next moment, liquidity feels like it evaporated. The Styx Curve Rank slipped under 30% before the air pocket. Not because it predicted China, because protection started getting repriced across the curve. That is the entire point. A structural signal does not predict headlines. It detects stress in how the market prices risk. When the structure cracks, the tape can look fine right up until it isn't. That's the entire point of term structure. It moves when the insurance market quietly changes its mind. A risk manager doesn't need prophecy here. He needs fewer days standing in the blast zone. And that's what avoidance actually means in real life. Not perfect timing, not bragging rights, just less time exposed when the probability of a bad outcome rises. Receipt 2, January 29th, 2018, Volmageddon. This one is famous because of speed, because short volatility broke fast. Volmageddon is a brutal teacher because it exposes a fantasy. The fantasy is that a low volatility regime is stable. Low volatility is not stability. It's a pricing condition. It can flip. Again, the Styx Curve Rank dropped under 30%. Different catalyst, same structural fingerprint. When that rank compresses like this, it's telling you the curve is no longer relaxed. It's telling you the pricing of protection is changing, often before headlines catch up. And here's what makes 2018 so important for today's conversation. When the front end is cheap, it doesn't stay cheap forever. It either stays calm and drifts, or it snaps. And when it snaps because people suddenly want the thing they were ignoring yesterday. That demand is not polite. It's urgent. It's crowded. Notice what I'm not saying. I'm not saying it called the crash. I'm saying it flagged conditions where caution has historically paid. Receipt 3, October 4th, 2018. This is the everything feels fine until it suddenly doesn't episode. 2018 is a great example because it wasn't one clean event. It was a regime shift. The mood changed, liquidity changed, sensitivity changed. The Styx Curve Rank fell below 30% again. And when it does, what it's really saying is the market is not paying for risk the same way it was yesterday. It's not drama, it's math. The curve is compressing. And when the curve compresses at the wrong time, you get air pockets. Air pockets are what people call random sell-offs. They feel random because they weren't watching the insurance market. Structure tightens, liquidity thins, then a small push turns into a larger move. This is the core benefit. Less time arguing, more time measuring. Because arguing is expensive. Arguing makes you late. Arguing makes you emotional. Measuring makes you boring. And boring survives. Receipt 4, February 20th, 2020. If you lived through this one, you remember the velocity. The pandemic period is the cleanest illustration of why cheap protection matters. When the world changes suddenly, the market doesn't negotiate. It reprices. The Styx Curve Rank was under 30% as the market entered the most violent repricing in modern memory. This is where the cheap protection lesson matters most. When protection starts cheap, the snapback can be savage. The front end explodes upward to catch the rest of the curve. That's the danger of quiet markets. They don't warn you loudly. They reprice suddenly. And if you're thinking, okay, but that was a once-in-a-century event, fine. You don't need another pandemic for the same mechanics to matter. You only need an unexpected shock while protection is underpriced. That's it. The mechanism doesn't care what the catalyst is. Now, here's the uncomfortable part. Those receipts don't guarantee anything. They just prove the dial isn't decorative. No signal is perfect. Sometimes it warns early and the market keeps levitating. That's not failure. That's reality. Risk management is sizing to regimes, not betting the farm. Let me say it another way. A good risk system is not a crystal ball. It's a circuit breaker. It doesn't stop storms from forming. It stops you from pretending a storm can't form. The Styx Rank is a map. A map doesn't drive the car. It stops you from taking the wrong turn off a cliff at night. So where does that leave us right now, at the time of this recording? Remember the setup. Historic VIX 9D discount. Market near highs. No urgent monster, but cheap protection. And cheap protection is a strange gift. It can be opportunity. It can be a warning. It depends on structure. Here's the rule set. If the Styx Curve Rank drops below 35%, but stays above 30, that's caution. It can mean that all discounts are ending, and ending doesn't automatically mean crash. It means the market is starting to charge more for near-term risk. That's the curve adjusting to reality. Sometimes it adjusts calmly. Sometimes it adjusts like a mousetrap. If we breach 30%, that's the red flag. That's where big drawdowns tend to live. Not always, not guaranteed, but historically, that's the neighborhood where the road gets icy. Two volatility behaviors matter here. First, clustering. Calm front ends tend to stay calm, until they don't. This discount says clear skies for the week. In a low vol regime, people stop buying insurance because nothing has hurt them lately. They sell it. They write it. They ignore it. They learn the wrong lesson from the recent past. And if nothing happens, that behavior looks smart, until it isn't. Second, mean reversion. A ratio around 0.70 is an outlier, deep in the tail. Eventually, the relationship normalizes. The gap closes. Benign. The 30-day drifts down toward the 9-day. Dangerous. The 9-day explodes up to catch the 30-day. That's the fork in the road. And that's why you can't make decisions based on price alone. Price doesn't tell you which fork you're approaching. Structure does. Now, I want to address the comment I already know is coming. Isn't this just doombait? No. Doombait is selling certainty. Doombait is saying, this will happen. A risk manager says, this tends to happen when conditions look like this. So what do you do with that without turning into a doomer or a gambler? This is educational, not instructions. But here's how a risk manager thinks when structure gets weird. Path A, the survivor. Stay exposed, tighten your risk budget. Smaller sizing, cleaner rules, less leverage. You're respecting asymmetry, not predicting doom. In real terms, this is the boring option. It's also the option that lets you stay in the game if the market throws a tantrum. You're not calling tops, you're just refusing to be fragile. Path B, the architect. Define risk before fear gets expensive. Not do this trade, just understand the principle. Cheap protection changes the math. When fear is cheap, you can define outcomes. When fear is expensive, you can only react. That difference matters. Path C, the watcher. Do nothing but monitor the public proxy. Watch the term structure. Watch whether the curve steepens, compresses, or flips. This is the path for people who want zero proprietary anything. Fine, you can still watch the insurance market. You can still watch the shape of fear, because the shape matters more than the headline. The goal isn't to be right. It's to stay solvent through regime changes and effectively avoid huge drawdowns. That's the entire Volataur philosophy in one sentence. You don't win by predicting the exact day of pain. You win by refusing to be overexposed when pain becomes more probable. The Styx rank is powerful. On its own, it's an effective guide for drawdown avoidance. But avoidance is only half the battle. That's why I don't use it in isolation. I fold it into the broader volatility framework, the Delphic engine, so it's not making decisions on one data point, one day, one headline. Because single input thinking is how you get tricked. A single indicator can look brilliant until it doesn't. A system watches multiple angles, then forces you to act like an adult. And if you're wondering what would change my mind, it's simple. I'm watching whether the curve stays structured or starts to compress. I'm watching whether the rank stabilizes or breaks that 30% line. Because that's the difference between quiet and fragile. Quiet can be fine. Quiet can be healthy. Quiet can be a normal low-vol regime doing normal low-vol things. Fragile is different. Fragile is when small events cause large reactions. Fragile is when the market stops absorbing. Fragile is when the curve tells you the system is losing shock absorbers. So yes, we're in a unique window, historic discount on short-term fear. And that is exactly why you watch structure. I'm watching that 30% line every morning. If you want to see where the Styx rank sits day to day, it's in the link below. Respect the volatility. It's the only truth on the screen.